It's a real pleasure to be here tonight. Having been born and brought up in a small town in Northern Ireland, which was quite parochial, I came to Leeds University in 1972, and that was a very liberating experience for me. So it's a particular pleasure, some 40 years later, to be able to return and talk about some of the things I've learned in the intervening period. And for that reason, it's a real pleasure to be here tonight. My career has had a rather unusual trajectory from being a consultant to being an insurance executive to being an entrepreneur. And all of this has been underpinned by a very strong actuarial underpinning. And it's very difficult to explain what actuaries do. I notice there are quite a few in the audience, so perhaps with a bit of trepidation, I try and explain it a little bit. But actuaries have quite an unusual mix of skills, a very strong statistical underpinning, and you will have heard the actuary jokes. The one for me that explains actuaries best is an actuary is somebody who thinks that the average person has one testicle. Think about it. And of course, there isn't such a thing as an average person. But what attracted me to the actuarial profession, and what really excited me, was a way that actuaries build computer models of organizations. And they use those computer models for making decisions about what organizations or pension funds should do. So it's a real mixture of science and judgment. And having spent the early part of, if you spend, which a lot of actuaries do, the early part of their careers building these computer models, it gives you a very good insight into how financial institutions work, and even financial systems. And actuaries work mainly in the area of long-term finance, pensions, insurance, and investment. But tonight, what I really want to focus on is not so much organizations, but financial systems. Because it's become obvious to me that over the last couple of decades, that financial systems have changed, and they've changed in a way which is quite detrimental to society and for the economy, in subtle but very economically damaging ways. And I want to illustrate that by two studies that I've been involved in, one with the Bank of England and more latterly one with the PLSA, which some of you will know better as the old National Association of Pension Funds. But let me start by telling you what got me interested in this area. And if I can take you back to 2000, which you may remember was the dot-com bubble. And it was that unleashed my entrepreneurial spirit. And like many others, I was sucked in to the whole tech bubble. And I built two tech businesses, one which was a home portal, and the other which revolved around commercial insurance for Lloyd's of London. And then in 2004, I was approached by a very bright entrepreneur called Hugh Osmond. And Hugh had made quite a lot of money building Pizza Express and Punch Taverns. And he had decided that he wanted to get into life insurance and asked me to help him. And over the 6 years I worked with him, he forced me to look at my industry through a very different lens and challenge every preconception I had about the industry. And I learned more about my industry, life insurance, in the 6 years that I spent working with him than I had in the previous 30 years. He also gave me the best description of being an entrepreneur that I've come across. And what he said is, as an entrepreneur, investors give me money. I then use that money to undertake risk. And because I bring particular skills at pricing, managing, or transforming risk, I generate value, which allows me to give back investors, in that case himself, more money. And it's very simple. And it's when you adopt that approach to running a business, it gives you a very simple number of questions and metrics that you need to know for managing the business. The only problem with all of this is it takes a long time to build a good business. In my view, it takes at least 5 years to build a good business, and more likely 10 years to build a very good business. And over the 6 years I spent working with Hugh, we built an organization which we called Pearl, but then listed under the name of Phoenix. And Phoenix was a business all about running off dead life companies. And its business model revolved particularly around the management of capital, investment, and risk. And we started off by buying 3 life companies, Pearl, NPI, and London Life. They're names that may be familiar to you. And we paid just over £1 billion for those 3 businesses. And over the next 3 to 4 years, we converted the value of those businesses from £1 billion to 2.5 billion. We then blew half the profits we had made on buying our biggest competitor, which was a company called Resolution, which was then a FTSE 100 company. And this was around about in 2008. And given we made liberal use of debt, that unfortunately left us with a highly leveraged business in 2008, which you may remember was the start of the credit crunch. And when the credit crunch hit us, asset values fell, spreads widened, and of course the business became stressed. But as any good entrepreneur will tell you, crisis creates opportunity. So we looked at this and said, what can we do? And we thought, we have lots of credit out there at 50p in the pound. We don't expect most of that is due to liquidity stress, lack of liquidity. So that's a great opportunity. So we recruited 25 to 30 credit experts, which had all come from organizations like Goldman Sachs or Deutsche Bank. And these were people who had issued the credit. And at that stage, we had assets and liabilities of about 60 billion, about a third of which were annuities. And we said to these guys, go out and buy 4 to 5 billion pounds of credit. And we want you to do it buying credit at 50p in the pound. And we want you to cherry pick this credit so that there are no defaults. And you issued all the credit, so you should be able to determine which is safe and which is risky. And so these guys went out and bought 4 billion pounds of credit, 50p in the pound, and we thought, great, we'll put this in the annuity funds, and it'll completely offset any deterioration in longevity that we've got. Because we knew that over a period of time, liquidity would come back in, and the price would go from 50p back to 100. And in fact, we were being encouraged to do so by the Deputy Governor of the Bank of England, Paul Tucker, who was going around to the life companies and saying, why aren't you guys buying credit? Now, what we then found, having done this, was that the Bank of England and the financial regulator, the FSA, had very different views of risk. The Bank of England didn't see this as a big risk, whereas the FSA did see what we had done as a big risk. Needless to say, the FSA view prevailed, and that was one of the things that we did that led us having to raise 400 million of finance to put into Phoenix, to put into Pearl. And the only way we could do this was to list the business. Now, at that point, having listed the business, which was a pretty difficult exercise, as you can imagine, in 2009, I decided to bail out, being somewhat scarred by the whole experience, and a bit cynical about financial services regulation and the lack of accountability of the regulator. Now, roll on 2 years. The financial regulator, the FSA, was being restructured and being put under the Bank of England. I was chairing an insurance company called Scandia, and on my board I had a very clever economist called Ian Golding. And he, knowing my views of financial regulation, introduced me to Andy Haldane, who at that time was the Director of Financial Stability at the Bank of England. And a number of conversations with Andy Haldane led to this Bank of England study. The conventional view at that time was that life companies and pension funds had had a good credit crunch because, with the exception of AIG, there had been no failures. And AIG, even though it had failed because of its non-insurance activities, not because of its insurance activities. My view was, as expressed to Andy Haldane, which he agreed with, was that life companies and pension funds had had a bad credit crunch because they had failed to act as counter-cyclical balancers within the system, fulfill their role in providing liquidity when the system was stressed. And the discussions that we had, as they led to this study, looking at the investment behavior of insurance companies and pension funds. But before I talk about it, let me just go back to being an entrepreneur. Because as an entrepreneur, I need capital. Capital, and especially long-term capital, is key to building businesses and to building economies. And if we don't have long-term capital, you don't have an economy. And that's relevant to us because, as you'll see from this slide, insurance companies and pension funds provide 80% of long-term capital in developed markets. This is World Economic Forum data, and it's a little bit out of date, but it takes total investments worldwide in 2009, and you can see that 65 trillion, 27 trillion of which is long-term, 40% of which comes from pension funds, and 40% from life companies. And it's this long-term capital that I want to spend some time on. And I want to talk about how the system and how the changes in the system impact the availability of long-term capital. Now, the important word, when I talk about financial systems, the important word to focus on here is system, because the financial world operates as a system, and unless you actually understand how the system is operating, it's very difficult to understand some of the trends that are happening. So let me explain the system as I describe it, and to do so I'm going to use a system called PLSA, and which I think is quite good for capturing systems. Now, at the heart, what I'm concerned about here are pension funds and life companies, but they don't operate in isolation. They tend to work with fund managers who make use of capital markets. And together these four entities form a network. And what this network does is the following. It takes money from savers, it then channels that money through the system and makes it available to UK PLC. UK PLC generates value, and that value is then channeled back to the beneficiaries, typically the same savers. And the important thing to notice, to recognize here, is that the value creation comes not from the pension funds, the life companies, the capital markets and fund managers, but from UK PLC, or the companies that are generating the value. And that these people in the middle are predominantly playing a facilitatory role. And in this sketch, I've used water to illustrate the flow of risk. within this system, pension funds and life companies, even though they provide products to customers and services, the way that they invest the money and the way they utilize fund managers and capital markets is crucial to the economy. And that's what the study was looking at. The study had this rather snappy title. But what it really was a study into the macroeconomic efficiency of life companies and pension funds. It was very much a first for the Bank of England, and it was the first study I've ever come across into the macroeconomic efficiency of life companies and pension funds. And it was done in quite an unusual way by the Bank of England. It was the first time they'd done it in this way. But what they did was they drew experts from these areas. They pulled together academia, pulled together industry, trade bodies, regulators to work together to do this analysis, led by a steering group comprising these people. And you can see in here some names you recognize, some eminent economists, pensions experts, life experts, regulators. And it was chaired by Andy Haldane himself. The study was about two things. It was about the way that life companies and pension funds bear risk. And it was about whether they bear risk in a pro-cyclical way. Now, bearing of risk is simple, and that's about quantity of risk. It's, do these entities bear a lot of risk or a little risk? And when I talk about risk, I mean predominantly investment risk. Pro-cyclicality is a little bit different. That's about the flow of risk. Do we all increase risk at the same time and reduce risk at the same time? Because that can be self-perpetuating if we do so. If when we respond to a situation, we all contribute to that situation, the effects can be catastrophic. It's a little bit like if we all rush to the side of a boat to correct its rocking, we all know what happens. The boat capsizes. And the problem with a word like pro-cyclicality is it doesn't really convey how toxic it is. But to try and get across that, take this list of companies. Now, hopefully, many of these names will be familiar to you. What do they have in common? Well, at one point, all of these companies were mutuals. Today, none of them exist as mutuals. Most of them don't exist at all, and those of them that still exist, like Scottish Widows, are owned by another company or have been bought by a proprietary company. And one, Standard Life, has listed, has had to raise capital and be floated. Why? Why don't any of them exist as mutuals? Because they all ran out of capital. And the reason they all ran out of capital was because of pro-cyclical investing. They all bought assets at higher prices and then sold them at lower prices. So, what did the study find? Well, it found that the ability of life companies and pension funds to bear risk has declined massively in recent years. Let me illustrate that. This graph shows the asset allocation of life companies and pension funds. And the bottom two blocks, UK equities and overseas equities. And you can see that between the 1990s and today, the proportion of assets in equities has dropped from 60% to 20%. Now, that's clearly had an impact on capital markets. So if you look at capital markets and you take UK shares, you can see in the late 90s, 50% of all UK shares were owned by life companies and pension funds. Today, that's actually under 10%. And this decline is principally linked to the imposition of mark-to-market based regulation and accounting. Let me illustrate that by looking at the life industry. This chart in red shows the amount of equities held by life companies in a non-linked fund. The green line shows the FTSE. And you can see that right throughout the 80s through to the early noughties, they were actually in sync. But at this time here, in the mid-noughties, they diverged. What happened then? The imposition of mark-to-market based regulation. The same thing happened, a similar thing happened in the pensions industry. Here we look at equities. The bottom block shows equity holdings of defined benefit pension schemes. And you can see that it went from 70% in the mid-90s to 40% at around about 2012-13, and suffered a real cliff drop. Some of it steady decline, and then fell off a cliff in the second half of the noughties. What happened then? We had IFRS 19, IFRS 17, mark-to-market based accounting. And that becomes very clear when you compare private sector schemes, which these are, to public sector pension schemes. Now you can see a steady decline in each because there's been shortening of duration, maturing of these schemes. You can see that public sector schemes, which are not subject to mark-to-market accounting, didn't suffer this cliff drop, cliff face that private sector schemes have. So regulation and accounting have played a large part in this de-risking. Let me turn to pro-cyclicality. We came across a lot of anecdotal evidence of pro-cyclical behavior, but we were very keen to get empirical evidence. And we did find clear empirical evidence of pro-cyclical behavior in life companies, not just in the UK, but in the US and France. It was less clear in pensions. The picture was more muddy. We even found some evidence of short-term counter-cyclical investing, but the whole picture was dominated by disinvestment, which had contributed to market instability during the credit crunch. It was quite tricky because we couldn't measure the use of derivatives, so we didn't have quite as clear a picture as we'd hoped for, but it was very clear the pensions industry was just dominated by disinvestment, and that private sector schemes didn't buy cheap assets in a way that local authority schemes didn't take that opportunity. The strongest evidence we came across of pro-cyclical behavior was heavy use of regulatory forbearance, both by the FSA and the pensions regulator. Now, if you look at what regulators do, they regulate the flow of risk into and out of the system. And regulatory forbearance is used a bit like a fire break. So when you've got pro-cyclical things happening, it stops it happening. But by the time regulatory forbearance is introduced, the damage has already been done. And companies can't anticipate it, so you've got to take action without presuming that regulatory forbearance will actually happen. And so what you find is that regulatory forbearance benefits weak companies and hampers strong companies. But the bigger problem that we found in DB pensions was one of herding. And when we measured this, we found levels of herding of in excess of 50%. And this herding was particularly high in the grey periods where we had business cycle contractions. And that was quite a concern. We were quite concerned about the impact of this herding on capital markets. So we carried out a side study into the index-linked gilt capital market. And here we found that the rush by life companies and pension funds to buy index-linked gilts had created a lot of demand, pushed up prices, depressed yields, which then inflated pension scheme deficits, which led to more demand, which pushed up prices again, creating a vicious spiral. And we measured the level of yield suppression in the index-linked gilt market. And if you take the long end of the index-linked gilt market, we found yield suppression of up to 165 bips from the actions of pension funds and a further 74 bips from the actions of life companies. So that yield suppression is quite considerable, feeding through and distorting pension scheme deficits. And we put this down to the way in which the pensions fund industry uses fund managers and investment consultants. In the words of one participant, asset allocation for the entire DB sector is carried out by 4 firms who all have the same strategy. So our conclusions are that the industry is not bearing enough investment risk, which is depressing returns to savers and shareholders. A lot of this is related to regulation, mark-to-market based regulation and accounting, reinforced by mark-to-market based industry practices. It's a bit like driving your car in second gear the whole time. The life companies were behaving in a pro-cyclical way. Pension funds were probably doing so also, although that was less clear. There's massive herding in the pensions industry, contributing to market instability. And in short, the industry is behaving in a dysfunctional way and not fulfilling its intermediation role. If I'm saving for my retirement, the logical thing for me to do is to put my savings into building companies whose profits are going to support my lifestyle in retirement. So I have a long-term agenda. My savings is based on a long-term agenda. Industry needs long-term capital. And the marriage of these two long-term agendas should combine to act as a powerful engine of growth for the economy. But what's actually happening is that a system that's inherently long-term we've introduced agency problems into that system. And something that should be inherently long-term is behaving in a short-term way. Everybody within the system is acting in an entirely logical and rational way within their silo. But the system as a whole is behaving in an irrational way. And the fact that everybody is staying within their silos and there's a lot of siloed thinking is contributing significantly to that. But as a result, the system is depriving industry of long-term capital, which is acting as a drag on economic growth. Now, at the heart of all of this is efficient market theory. And I'd like to highlight 3 flaws in efficient market theory, which occur when you apply it to long-term businesses. The first is that efficient market theory uses volatility as a measure of risk. 1 year VAR is not a good measure of 20-year risk. Secondly, efficient market theory assumes that liquidity is free and has no value. We know that not to be true. And thirdly, it assumes that the only difference between a 1-year liability and a 20-year liability is the time value of money, which fails to capture the value of illiquidity. And all of this stops pension funds and life companies from exploiting their inherent illiquidity. And this leads to a fundamental flaw in the way we look at risk. Which of these two periods is riskier? This is 2007 to 2009. Is this first period, when the FTSE's high and vol low, riskier than the second one, where vol is high and asset values are low? If I'm a long-term investor, this period is riskier because asset values are high, I've more to lose. But if regulation is based on vol, it's telling me risk is high when it's low. And here it's telling me risk is low when it's actually high. It's sending the wrong signals. And this can lead to a fundamental flaw in the way we look at investment. I spent 4 years working with one of the cleverest investors I've come across, a guy called Jan Stratman, who was CIO of ABP in Holland. And his view was that it's very difficult to generate alpha in efficient markets. If you can generate 50 bips to 100 bips, you're doing extremely well, but you can't do it year in, year out. Whereas in inefficient markets, it's far easier to generate alpha, but you can't do it from behind a screen. And it requires a far higher level of skill. And an organization that does this extremely well is CPPIB, the Canadian State Pension Fund. And that invests 50% of its assets in alternatives, predominantly illiquids. And in doing so, it's generating investment returns of 8% per annum nominal over the last 10 years, 5.9% real. So I'd go further and say, what is all this investment? For me, as an entrepreneur, investment is something that happens over a long period, 5 years or more. So what's all the stuff that happens in less than 5 years that we call investment? Is it really investment, or is it just trading, betting against markets? Now, this study led to the pensions industry carrying out a review of the DB pension sector, which had been under pressure for some years. And I was asked to chair an industry task force looking at the defined benefits pension sector. And we produced a report last October, and I'd like to sort of turn to show you some of the things that emerged from that. So if I just switch. This is a report we produced last October. And it looked at the industry from a number of perspectives. How well does the system work? Is it meeting the needs of employers well? Is it exploiting capital markets in the way it should? And above all, is it delivering the pensions to members in the way that it should do? Because millions of people depend on DB pensions for their security in retirement. And DB should be a major force for good, for economic growth and economic efficiency, huge society and economic growth. And we felt it important to actually determine whether it's behaving the way it should, because it is a vitally important part of the economic system today and will continue to be for the next 4 to 5 decades. So these were the parts of the system. We used this diagram, we drew it to be a little bit Heath Robinson, because when we looked at the system, that was how it felt to us. It was something that had grown up and effectively become cobbled together over several decades. So first of all, take members. We have over 4 million members who get a pension today. 20 million people expect to get a pension. The average pension isn't high. It's about £7,000. But that £7,000 is the difference between retirement on the breadline or with a bit of comfort. DB is a key provider to capital markets. It invests £1.5 trillion in capital markets. That figure's doubled over the last decade. And you'll find that DB schemes own something like 80% of the index-linked gilt market, major parts of capital markets. If you take employers, it matters to employers who have chosen to provide DB schemes. And these employers are spending massive amounts of money on DB schemes. £31 billion contributed to DB schemes last year. That's 9 times what was put into DC schemes. Employers have contributed £350 billion to DB schemes over the last decade. And nearly a third of that 31 billion, over a third, 11 billion, was to make good deficits. Yet despite these massive amounts of money, deficits just keep getting larger. And employers are really running to stand still. And so we concluded that the system isn't working as it should. And it's got a problem, and a problem that's difficult to understand just by looking at DB at deficits. What we felt you had to do was start by looking at what really matters, which is the risk to members' benefits. So that's what we set out to do. And we built a model that combines covenant risk, an integrated risk model that combines scheme risk with covenant risk, and looks at how the health of the employer combines with the health of the scheme and how that translates into risk for members. And we set that against the understanding of members in terms of the risk to their benefits. And we applied that to 4 covenant groups that the regulator adopts. And if you take the first one, schemes with strong covenants, strong employers, there's very little risk to those schemes. We projected that only 6% of them would be expected to default over the next 30 years. If you take the next group, we find that 27% of these schemes would be expected to default over the next 30 years, which is the sort of lifetime of the pension scheme. But the real problem lies with these 2 last groups, the ones with weak covenants and tending to weak covenants. And here we find that 65% of these schemes would be defaulting, and 40% of these schemes would be expected to default before the benefits were secured. To put it another way, for these last 2 groups, which represent a third of all liabilities, there's a 50-50 likelihood of the employer falling over before the benefits are secured. So members are bearing a lot more risk than they think. Of course, they're protected by the PPF, which ensures the benefits. But you need to be realistic about how much risk PPF takes off the table. When you allow for haircuts, different measures of inflation, etc., PPF only protects 75% of the benefits. 25% of the benefits of the risk is borne by members. And what do members think? 71% of them believe the benefits are guaranteed. Less than half have ever considered that a deficit might imply risk to their benefits. And when you look at employers, they're running to stand still. DB schemes are significant consumers of corporate capital, 11 billion last year to make good deficits, 15 billion the first 3 quarters of this year. 11 billion 2015, 15 billion the first 3 quarters of last year. And this isn't money that employers are paying to retain and attract current employees, because the average scheme has only 16% active employees as members. The remainder are ex-employees and retired people. It's money that employers are paying to make good historic promises. And that money can only be spent once, and if it's spent on pension schemes, it can't be spent on wages, which have flatlined for the last decade. It can't be spent on investment or dividends. So it's very clear that employers are struggling to manage the cost of the DB schemes. And it's no surprise that so many schemes have closed to new members and to future accrual. And it's not just the deficits that matter, it's the volatility of these deficits. And it's a volatility of deficits that have caused many employers to take investment risk off the table. And if you model the aggregate risk of taking less investment risk, it doesn't necessarily reduce risk to members' benefits. What we find is that if you take less investment risk, you lock in the deficit, you bake in a longer recovery period, you assume greater employer covenant risk before the benefits are secured, and the end result is that you're taking less investment risk, more covenant risk. You've just moved risk around. And in aggregate, we find it actually increases the risk to members' benefits. And we're getting this happening across 6,000 schemes. And when you look at these schemes, you're finding that only a handful of these schemes have got scale. You're finding that you've got a few hundreds of smaller schemes and thousands of very small schemes. And so many schemes that you've got very divergent levels of governance and skill across the system. And with very few schemes able to capitalize on economies of scale or being able to negotiate properly with suppliers. And that matters because when you look at the impact of scale and governance, it can make a real difference to your investment returns. Research has demonstrated that scale and governance can add 1 to 2% per annum to your investment returns. So we've got 6,000 schemes, and they're all operating by 6,000 groups of people with a whole chain of advisors. Lawyers, accountants, actuaries, asset managers, investment consultants, custodians, covenant advisors, each of which have a profit to earn. And often, as the FCA has concluded, with limited alignment with the schemes, with the clients. So you end up having a very messy system. Too many people running too many schemes with the help of too many intermediaries. And throughout all of this, we have a massive intergenerational transfer of wealth. 2 baby boomers from their children and grandchildren, which for me feels absolutely wrong. So, where's the study taking us? Well, we believe that 6,000 schemes operating in this way is just untenable. And that if you're going to improve the system, you need some form of consolidation. And we're currently working very closely with the DWP to identify possible ways to consolidate the industry. And we believe there are big benefits to schemes, to members, to employers, and the economy through consolidation. The real question is whether the government will find space in a Brexit-driven agenda to take forward consolidation. Now, I've tried to convey how our long-term financial systems have become corrupted. And at the heart of this, in my view, is an inappropriate management of risk and investment. By putting financial economic techniques applying them to the management of long-term sectors without thinking through the consequences of doing so and the implications. And it's only natural that if you apply investment banking techniques to pension funds, you convert them from being investment people into being trading, giving them trading behaviors. And a more fundamental distinction that we need to consider is the difference between idiosyncratic risk and systemic risk. Much of our regulation is down to idiosyncratic risk, failure of individual firms. When you look at pensions legislation, a lot of pensions legislation we have today was driven by Maxwell. So some of the life insurance regulation we have today was driven by Equitable. And in the last 30 years, that has been our focus. But I think the biggest risk we have today is systemic risk. And when you look at systemic risk, you need to understand the system. But then you have to ask yourself, who owns the responsibility for the system? Because everybody's behaving totally rationally, according to their mandates and their objectives and their obligations. The only person who owns responsibility for the system is government. You have to ask, do regulators really consider the systemic risk of their regulation? Not really. The Bank of England does quite a lot of work looking at systemic risk, but what it does, in my view, only scratches the surface. And we need a lot more work and research into systemic risk. How systems work. How is value being transferred between different constituencies? Are middlemen extracting too much rent? Are we having intergenerational transfers of wealth? Is value being transferred inappropriately from institutions like pension funds and life companies to investment banks and other institutions, capital market institutions? In an increasingly interconnected world, I believe understanding system risk will be the challenge of the next 20 years. And if we don't rise to that challenge, the people who will bear the cost of it will be our children. And they're not going to thank us. Thank you.